Next up is AI, machine learning, and quant trading. We've got Dr. Julia Speck is going to be our moderator and discussion leader here. Julia, I'm going to hand it over to you, and you could have each of the panelists introduce themselves and get this show on the road.
Thank you so much, James. Thank you so much for opportunity of our participation in this event. So a second time I'm in the conference. Is probably by far the best panel discussions on machine learning and AI and quant. So very pleased, James, giving opportunity to join again. So it's a great pleasure to be panel leader or moderator on this very, very high profile panel where we have leading managers in quant space as well as the very well-known allocators in the space. So we'll give us a very sort of diverse perspective. So if I may kickstart and ask Francois, Anthony, Vasilis, and Bastian to introduce themselves.
Sure. Should I start?
Perfect.
Yeah, I'm head of trading at Typhon Capital, which basically means overlooking and recruiting quant portfolio managers that fit our objective. And our objective is really to deliver non-correlated performance. And we are basically focusing on short-term trading opportunities, typically a couple of hours to a couple of days holding period. Currently, we are mostly present in cross-asset portfolio trading futures, but we may expand in the future to other instruments and in particular cash equities.
Perfect, thank you.
Shall I continue? Yeah.
Yep.
So hello everybody, thank you very much for having me today. I'm Bastian Bolesta, founding partner and the CEO of Deep Field Capital. Deep Field Capital is a Switzerland-based systematic asset manager. We focus on the development of short-term and intraday trading strategies. Have been doing that for the last 25 years. We do that on the futures and cash equity side. Yeah.
Perfect, thank you. Vasilis, would you like to proceed?
Sure. Hi everyone, this is Vasilis from Falcon Money Management. We are a fund of hedge fund business based in London with around $1 billion AUM. We invest globally across all strategies, but really specializing in market neutral, RV, trading oriented strategies. And this obviously includes quant and systematic managers, where we have exposure to, what people usually call diversified multi-quant strategies, as well as managers with a more, distinct style, I'd say. And the common theme in that mix is that we tend to focus on shorter horizon, higher turnover strategies. And yeah, I'm a part of the research team responsible for quant strategies.
Perfect, thank you. And Anthony?
Hey, I'm Anthony, work for Joy Investments, New York-based family office. We primarily invest, well, in most kind of strategies from all different time horizons. And yeah, we have a focus in quant, and more specifically quant equity and quant futures. Yeah, that's about it.
Perfect. Well, thank you so much. I think with my first question, I will kickstart with the managers, and we'll sort of go to the very long-standing discussion at quant conferences on machine learning and AI. And effectively, there has been so many challenges in applying these techniques to, forecast tomorrow returns or security selection more generally, non-stationarity, regime switches, and so on and so forth, causality, correlation. So what is your take on that, on these challenges, and how much is it really sort of new techniques versus repackaging of old statistical methods, and how, to which extent are you relying on machine learning and AI in your strategies?
Should I start again, or?
Please, sure.
The same way. Well, I think it's a complex question because basically behind AI you have a multiplicity of tools and techniques first, and you can apply it to multiple problems as well, right? One is alpha generation, one is optimizing your execution, one is building your portfolio. Like, you know, then you would need to map each technique to each problem and so on. But then the question is complex. I think I have, however, a couple of remarks. The first one is I would see AI as it's just a tool, right? Then when people start to move from saying it's a tool to it's a magical trick or the golden thing to solve all problems, I start to get worried. Personally, I have a personal bias because I like to understand what I'm talking about, and I don't often understand what I'm talking about when it's about AI. Then I'm rather on the conservative side. Having said that, I think it would be stupid to trash the whole technology, and there is a lot to be harvested. But I think the key question is the tool the right tool to solve the problem I'm trying to solve right now? And for me, AI is basically something excessively powerful to manipulate an enormous amount of data, which basically means that if you are sorting a portfolio construction problem in equity where you have 5,000 instruments, or if you are trying to solve a tick data execution problem where you have data excessively frequent and then you have a much broader database, I think the tool will be much more relevant than if you are trying to sort an alpha generation problem on a single instrument with a monthly frequency, for example. That's the sort of overarching thinking. Having said that, I mean, I'm absolutely not against the technology, and we use it in some part of our processes. But I think that the key question, I mean, I'm quite concerned I don't buy that AI will sort everything, and I have not seen many areas where it proved substantially distinctive versus the traditional methods, I would say.
Clear. Thank you so much, Francois. And Bastian, if I can get your perspective, would be really great.
Sure. Yeah, I really like the different angles, the alpha generation, optimization of the execution, portfolio optimization, because it reflects to a certain degree our experience in-house as well. On the alpha generation side, we are not so bullish so far, following the narrative that if you generate signals and you don't really know the underlying factors, and contrasting that with that everything else we do is basically based in behavioral finance, where I can really explain why we actually get a trade, we are not as comfortable. But if we think about optimize the execution side, this is certainly an area where we have looked into and where we're currently working on solutions as well. And the portfolio optimization is also something we're not necessarily on our side at the moment, but if we talk with peers and look in the space, that if you look about how you would like to size your trades or what kind of strategies, how you would like to balance them in a portfolio, where AI techniques or machine learning techniques have proven have shown value already, and it's not something in the future. Generally speaking, we are very open-minded to look at these things, and have made very good experience with basically explaining that our 2 days development and success is based on technology being available and data being available. What we do today across our intraday and short-term programs would not have been possible 10 years ago. And it's always a question of perspective. Probably if we had the panel 10 years ago, people would talk about what we do today as AI and machine learning. And now we just say, well, that's a high degree of automation. And today's AI people talk about things substantially differently. And we can confirm, as Francois just did, that it is a very interesting topic. We have different parts of it applied on our research side, and are working it on the execution side, and are very open-minded to further expand on that going forward. But it's not breathtaking or mind-blowing so far in terms of results. it's more entertaining. And when I look out and hear that computers are now able to play poker against human beings and succeed. Poker is a very complex game. You can relate the playing poker to what happens in markets as well, where you have a lot of actors where you would like to beat another actor who may bluff as well in its behavior. And this is already a substantially more complex form than a computer playing chess. Chess and Go, and now we have poker. So they're getting closer, I would say, and everybody should be open-minded and push forward to incorporate these things. Otherwise, you probably will die out.
Absolutely. And I guess my next question will move to investors on the panel. I guess until sort of February or January this year, on many panel discussions, we were speaking on the Quant quake and meltdown of 2007, sort of alluding to the challenges of investing in quant strategies. And yet this year, sort of from March onwards, has been very tough for some of the managers in the space. If you could, give us some color on your experience and sort of reflection on quant managers' performance this year so far, and especially if you can give us some angle on machine learning and as in managers in the quant space who are supposedly driving alphas from machine learning and AI.
Vasily, do you want to take it, or should I start?
I mean, I'll start. Performance has definitely been challenging this year. I mean, this has been the case for the last 3-4 years. So it's, generally tough. And it's very hard to, explain. And there's, I think year to date, if you look at averages and large peer groups and so on, the median return is indistinguishable from zero. So, that's, that's not very promising. And what is, I'd say, particularly frustrating is the fact that you have large dispersion of returns, even within like subgroups and peer groups of managers that are supposed to be more, similar in style. So yeah, I mean, it's a tough environment. It's definitely hard to, explain performance. March was as you kind of alluded to, very much similar to August 2007, meaning, there were steep drawdowns mid-month, and those who cut risk at the, possibly at the worst possible, time, they crystallized losses, and then the rest of the managers, they bounced back, even ending the month, all the way back up to flat or positive in many cases. So that was, very interesting as kind of a repeat of the, how August 2007 played out.
And Vasily, just maybe to follow up, did you observe differences between, say, those managers who, supposedly rely on just more traditional techniques versus managers who say they heavily deploy machine learning?
I mean, it's hard to tell. It's hard to tell. I think if you looked at peer groups of, both these, schools of thought, you'd see that the averages are probably close to each other. Personally, when I look at managers, I don't really prefer the traditional versus AI divide, as Francois and Bastien mentioned. These are tools. It's all about how and why and where you use them, and so on. And when I look at managers, I prefer to distinguish between two schools of thought. One being the more data-driven, follow the data without asking too many questions, and the other approach being, you know, intuition driven, where you care about why, right? It's a very different school of thought. So when I look at managers, I try to, you know, rank them on this spectrum. Yeah, I'd say maybe to kind of answer the question, what we've seen recently is that larger, more established managers are doing better than the smaller kind of startup type managers. That's definitely an observation in terms of, you know, the performance across the industry.
Yeah, well, thank you so much. And Anthony, what was your experience?
Yeah, I think by attempting to answer that question, I probably will touch on things that Francois and Bastien talked about in the original question you posed. If there is an edge in machine learning, and if there is repackaging and kind of like, you know, just a marketing, yeah, I mean, there's no doubt that machine learning has become a buzzword, right? And when that happens, just like the alternative data, you know, of a couple of years ago, you know, it's going to attract a lot of different players, right? So, you know, all these different players, I think, and well, machine learning has like the information and the research has been around for decades. It's just, as Bastien said, only recently the technology is up to par and you can actually use it to crack the financial markets. And because of that, there's many academic papers, you know, and, you know, if managers are digging into those papers that are well, you know, are widely available and easy to understand if you are a manager, you might run the risk of getting the same results, right? So I think what's happened this year is a lot of people actually just realize that are doing similar things because they are, you know, fishing in the same pond than everybody else. And I think crowdedness is a big, big issue. And even though machine learning appears to be a place in which crowdedness is harder, you know, saturation is harder to happen just because, as both Francois and Bastien said, you know, you could use it in a lot of different capacities. It's not just signal generation. It's evident to me that it's still, you know, it's here for machine learning managers as well. You know, at the end of the day, to Vasilis's point, I think performance is all over the place. It's hard to just pinpoint, like, you know, say, oh, it's a good year or a bad year. I think in every other, like, you know, just like in any other strategy, you will have winners and losers. And, you know, it's our job to maneuver around the noise and try to find the gems. And I don't see anything that, you know, I have some people in mind that are up 30, 40, 50% in a year, and other strategies that are, you know, on the other side of the spectrum. So it's all over the place.
Yeah, no, perfect. And as we sort of have an overarching consensus in the way that there are so many areas, right, where one can't take a blanket approach, okay, machine learning in investing, right? So we have portfolio construction, we have risk, execution, and maybe if we take sort of a, you know, forward-looking stance and again, question to the entire panel, and if you could, you know, elaborate a little bit on where the opportunities lie in your view the most, where you would say research should concentrate on, you know, with the sort of prospect of the most practicable outcomes within those areas: execution, risk, portfolio construction?
I'll take this one real quick. I mean, again, I think every manager, every brain, every background is different. So I think it would be silly for me to say, you know, who am I to say you should focus on that, right? I think each manager knows their strengths better than anybody else, and they know where they can, and their systems, right? So they know, you know, they have a better idea on where to apply these tools. You know, for some people, it might work better in the signal generation. For some people, it might just be for data. For some people, it might be execution. I think for some, might be everything, right? It might be a pure machine learning shop. And I think it really, there's no blueprint, there's no, you know, rule. I think it really depends on the mind and the system.
Any other thoughts from the managers?
Yeah, I said earlier that position sizing, portfolio optimization is a very interesting field. We have seen some interesting results there, supportive, additive to what we already apply internally. So it's less about generating a trade, having a trading idea. It's more about putting it in perspective with other opportunities specifically in that given moment, and use a lot of data, maybe even non-traditional data, in order to size it. That's an interesting field. Because you also said what will happen, what will work going forward, or what we are currently facing. There's a lot of interesting research out there at the moment from people like Mike Green and others who have focused on the massive inflows in passive investments and ETFs and what this does to markets. And ultimately, if these people are right and the research is very interesting and one can observe certain things there, that means that markets will become more digital, because the inflows in the ETFs, if they're already invested, there's not much drive anymore. It's only when there's rebalancing and things like that, and the selection process of single names in markets or specific investment ideas will actually become smaller and smaller in terms of impact. And in a digital world, it can be more beneficial to be rather short-term, not having long-term holding periods. Something Vasily said at the beginning when he introduced himself, being more on the short-term side of things, as Roy Niederhofer just did in the presentation. He made a good case that if you add classical CTAs, as Vasily said, the SocGen Trend Index is currently down 1% year to date, and the short-term traders only slightly up. So the CTA space as a whole hasn't really delivered until today. Basically this year there have been some glimpses where there was some positive performance, but generally speaking it's just not showing that it's really adding value and being added to classical portfolios of all these investors out there who have these headaches. And in a more digital world, which is more on off and more directional as a result of it, it can be beneficial to become quicker in doing things, which is a technical aspect, machine trading aspect, and at the same time also have shorter holding periods. And I think that's probably a trend which will increase going forward, and will have certain managers who have these characteristics.
Francois, any thoughts on your side?
I mean, I think it's as Anthony said, it's a very complex issue. I would distinguish probably, I mean, I think we mentioned alternative data, and again, I think you have a lot of bullshit going on that front as well. But I however think that the depth of and breadth of data will be something that people will tap into to generate alpha. I personally think that it's not a level playing field, because the big guys can buy the data and digest it much faster. And there will be, especially on the cash equity side, a race for the very big guy to consume the data as soon as it becomes available. And I expect this to already be the case. Especially on the cash equity side, I think it's more applicable. Whilst for the smaller people, probably, as Bastian mentioned, it's probably digesting the price data that is already encompassing so many data and doing it in a more nimble and flexible way than the big guys can do. Then I would see a bifurcation there between the two groups. Personally, it's a completely different matter, but at a much more micro level, I'm a big believer of diversification for quant programs. I think it's the art of what we are doing, and our focus will be on diversification, both in terms of signals and instruments, because I think that especially the instruments one, it's a very safe way to pilot your research and get some tangible outcomes out of it. It's like, replicating something that has been successful to other markets. And in the future space, the liquidity that exists in Chinese and to a lesser extent Indian futures market we are just at the beginning of that story, and I would personally expect this to be a big game in the years to come.
Any other thoughts on this from the other members of the panel?
I mean, we as allocators to quant hedge funds, we're not very picky. We'll get edge, wherever we can find it. What we've been spending quite a bit of time on in the last 12 months is the China A-share market, which is a very large and liquid market, and it seems like there is a deep alpha opportunity there. The opportunity set is exceptionally attractive, both in absolute and relative terms. So that's what we're focusing on in terms of our pipeline and due diligence priorities. But yeah, I mean, and more generally, I think there's always going to be opportunity set for things like Statar that has a function in the ecosystem, providing liquidity to the market short term. These strategies are not going to go away, and if anything, they do better in volatile regimes, and we've seen that this year for sure.
Very interesting. And just perhaps follow up to Francois and your comments, Vasilis, on the opportunities in China or Asia more broadly. How do you, from your observation so far, on locally based managers versus international managers, do you have any thoughts and views who is better equipped to access that alpha in A shares?
I mean, we have a preference for managers that have links and connections locally. Most of those managers, they tend to have a large team in the mainland, and they've had a presence there for many years, even though they earlier in their career they may have been elsewhere, right? But obviously, we invest in offshore funds that trade out of Hong Kong. So this is the kind of the restriction in place in China, but that's kind of part of the opportunity set, right? That's why it is what it is. There are barriers to entry. But yeah, I mean, being local and understanding the nuances is definitely valuable.
Absolutely. They will also do better job on natural language processing, I guess, right? should they deploy those techniques? Well, thank you so much for the answer. And to follow up on the allocators, investors perspective, when you meet managers who, suggest, or at least their presentations suggest that they are heavily relying on quantitative or machine learning and AI in particular, do you deploy any additional techniques in your due diligence, to get that better understanding? Because clearly black box has been, a long-standing problem for quant managers in general, but I guess even more acute problem for machine learning managers, or managers that heavily rely on those techniques.
Yeah, I think with quant investing and analyzing quant managers, it's hard because these managers have a tendency to be very protective of their IP, right? And I think it should be that way. We're in one of the most competitive fields in the world, where dog eats dog, and alpha evaporates quicker than water. So I understand them, being protective of what they've built, but at the same time, in order for a relationship to be successful in this business, there has to be comfort from the investor side as well. So I think managers should at least try to make their investors comfortable with what they do in their process. And, you know, that leads to longer relationships, higher AUM, and you know, it's a win-win. As far as things that we do, you know, we don't ask for secret sauce, if that's what you're asking. I mean, we're not quant developers or traders. Like, even if we had the secret sauce, it's probably useless to us. You know, each system is built by somebody, and that person, you know, has strengths, weaknesses, understanding of the market, flexibility of mind or not. So, you know, analyzing that person, well, all those traits will somehow find a way to be reflected on, you know, one way or another in the system, even if they don't understand it or not. Everything, you know, the system is only as good as the creator. So spending a lot of time with the manager, understanding the way they think, you know, gives us a good a good view of, you know, what we're looking at. Don't get me wrong. I mean, we spend countless hours, you know, going through how the system is built and you know, all those beautiful things. It's just the people side is very important to us. And yeah, I mean, ultimately we're in the business of results, right? So even if we had a perfect information on what the manager does, if those expectations are not met, that's meaningless, right? You know, we're not, you know, paying for dinner each night based, you know, because of theories. We pay for dinner because of positive P&L, and that's the most important thing. So yeah, there are ways we deal with that, but I don't think I'm allowed to share those.
Clear. Clear. And Vasilis, from your side, any additional due diligence or techniques for assessing the managers?
I mean, I'll probably echo, you know, Anthony's comments. We follow our normal due diligence process. We try not to be dogmatic, you know, our black box type strategies, good or bad. That said, historically, we have stayed away from black box type strategies because they are, you know, objectively harder to underwrite. There's no way around that, and especially if you're, you know, a fiduciary managing money for you know, clients. And yeah, I mean, no one ever shows you, you know, the secret sauce, right? They show you just enough to give them, you know, credibility and explain the story, but not too much.
Yeah, I think we have maybe time for one.
On your question, because
sure.
When personally, when screening for traders and PMs, one thing that made me concerned personally on specifically on AI is when the machine is taking over and somehow the money is not in control. Because ultimately, as I said, I think it's a tool and it should be used in a within some mandate and constraints. And sometimes you have some machine learning systems where the results are not reproducible. At some point, the machine can take over and so on. And I think those ones you should stay away from them because they can turn very nasty.
I guess what Vasilis said, black box, stay away. Do we, James, have any time for any question for the audience, if there are any, or it's probably not much time left? I think James doesn't hear us. I think.
Sorry, no, I hear you. Sorry, I had to unmute. We've got a couple minutes for questions. So let's see, I see one popping up here in the Q&A. Oh, no, that was Dog then. But yeah, if anybody's got a question, feel free to click that Q&A button on your screen and raise a hand. We've got about 3 minutes for our esteemed panel here. And while we wait, I just got a comment. Anthony, how did you get gray hair over the summer?
It's these markets, man.
Look at that, right there. See it? Front left.
No, it's the lighting. It's the lighting.
I don't know. That looks like a gray to me. The jet black Grecian hair.
I'm just kidding. But in all seriousness, I wanted to add something to what Vasilis and Francois said about diligence. I guess one way to deal with, you know, the black box and not having perfect information of what you're actually investing in. Well, in those cases, and if it seems interesting to us, we at times do like what we call active due diligence, in which, you know, we allocate just a small amount of capital, hopefully in a managed account structure, and that gives us a lot of information as far as the patterns, how it compares to the book, how it compares to what, you know, they've told us. So, you know, you can get, it's information rich to have a managed account in those cases, and you could go through the trades and really understand what's going on.
Brilliant. I was just about to say, any other concluding remarks from the panel?
Yeah, we would agree to Anthony's take earlier that it's a rightful concern of a manager to protect its intellectual property. But at the same time, a manager should also be able to provide a narrative, what he's doing, to reflect that or mirror that with market movements. An investor should be able over a certain period of time to actually understand when a manager takes positions, how large these positions are in general. For example, if you a momentum trader and you trade a specific market and you see a follow-through movement in that specific market, and you over and over either don't capture that or you lose money in your given time period, then something is wrong. Then you may be not telling the right narrative in regards to what you're doing. But that's how one should probably approach it. Black box is a really harsh term, but you can open up the box and actually shine the light in the corner here and there. And ultimately, what Anthony also said, data is really important. So we do that in-house as well. When we decide to add a sub-strategy to one of our multi-strategy programs, like the VOLA program, for example, it runs through a similar rigorous process. So we take the data, we do the analysis, how does the correlation look like from that specific sub-strategy to every single other component I have in the portfolio. I'm looking for anti-correlation here. So best negative correlation when the other sub-strategy is down, and positive when it's up, and positive capture in both cases. And if you do that, you can build very diversified portfolios. Diversification was something Francois pointed out earlier, and that basically requires certain correlation characteristics. And anti-correlation, which can be found in the quant space, specifically in regards to traditional asset classes, is probably one of the most undervalued components when building a portfolio. And as such, it should be a central part of a due diligence process, that you take the data, and not monthly data, you take daily data, and then you run your analysis over longer stretches, and you should get updates from the manager as well. And then you cross-check and mirror that to what's happening in the market. And I think that's a good approach to even work with managers and strategies where you may not be as familiar with, that you first start with the data set, and then you can frame it by human interaction as well. If you like the people, are they consistent in the story and things like that? I think data, diversification, specifically correlation characteristics, thinking about what happened in March, everything going down basically again, no place to hide for many investors. So it's key that you provide truly diversified returns, and that should be part of every single due diligence, I would say.
Great. Well, thank you, Sebastian, for this excellent comments. I think on this note, I'm going to thank everybody for their point of view and perspective, and excellent discussion on this panel.
Thank you very much for having us. Thank you. Take care.
Bye.